Have you ever done the math on how long your money would actually build wealth if you had to bet your financial future on a single asset class? Not the vague version pushers on social media sell you, but the real one. Most people get a knot in their stomach somewhere around the second line of that calculation and quietly close the spreadsheet. It's not just you, and it's not because you haven't researched enough. The wealth creation paradox is that the people who choose the wrong asset usually didn't pick a bad investment, and they didn't get terrible returns. Two investors can start with the exact same $100,000, hold their assets for 30 years, work with the exact same average market returns, and one ends up with barely $800,000 while the other crosses $4 million. Nothing about how hard they worked separates them. What separates them is a filter almost nobody checks: the mechanics of how leverage, tax drag, and operational costs interact with compounding. The moment money goes into an illiquid real asset instead of a liquid paper market, simple returns stop being the headline, and structural efficiency starts deciding everything. Understanding that building true wealth is a structural problem, not a simple return problem, is the first step to making sure you land on the winning side of that math. There are 3 levers that control it. And by the end of this script, all 3 will be yours. Let's run the experiment properly, because the claim I just made sounds impossible, and impossible claims deserve a controlled test. Take 30 consecutive years of broad market history. Booms, crashes, inflation spikes, everything. Hand those 30 years to 2 identical investors holding $100,000 each. Call them David and Marcus. David puts his cash directly into a passive S&P 500 index fund. Marcus uses his $100,000 as a 20% down payment on a $500,000 residential property. First, the plain paper control. David never touches his stock portfolio, never adds a dollar, and simply lets the compounding run at a historical average return. 30 years pass, and David's $100,000 lands on roughly $1.7 million. Now change one thing. Marcus takes his property and rents it out, allowing tenant income to cover the mortgage, while the property appreciates at a modest historical average of 4% a year. Same initial out-of-pocket cash, same 30-year time frame. Marcus finishes the 30 years with a paid-off property worth over $1.6 million, plus decades of cumulative cash flow and tax write-offs, pushing his total net position past $2.5 million. Same starting capital, lower base asset return percentage for the property, yet a dramatically higher final balance. One variable changed the ending, the structural leverage, and the trigger that armed that variable was the debt mechanism. The moment cheap bank money was allowed to compound on an asset 5 times larger than the investor's cash. Which means this isn't only a story about landlords versus day traders. This math switches on anytime you deploy capital into assets with vastly different tax treatments and borrowing capacity. 30 years is simply where the mechanism is easiest to see. So, let me show you the mechanism one step at a time, using David's stock portfolio first. Year 1, the stock market gains 10%. His balance becomes $110,000. Year 2, down 10%. His balance drops to $99,000. Year 3, up 20%. His balance moves to $118,800. Notice what is happening. David gets maximum liquidity and zero management friction. He clicks a button on a phone screen, buys his shares, and goes back to sleep. But his growth is strictly limited to the growth on his initial $100,000. He cannot force the market to compound faster, nor can he easily borrow. $400,000 from a commercial. Bank at residential rates to buy $500,000 worth of stocks on day 1, without risking a margin call that wipes him out in year 2. Watch what happens to Marcus on the property side during those same years. Year 1, his $500,000 house appreciates just 4%. That is a $20,000 gain on his $100,000 cash invested, a 20% cash-on-cash return. Year 2, the property market stays flat. His tenant pays down $8,000 of the mortgage principal. That $8,000 is pure equity added to his balance sheet using someone else's paycheck. Year 3, inflation ticks up, raising the property value by 5% and allowing Marcus to raise rent. 3 years in, David's liquid paper is up 18%. Marcus's total equity has grown over 50% because his gains were calculated against a $500,000 asset while his debt remained fixed. That's the mechanism in one sentence. Leverage multiplies the size of the asset, doing the compounding, while fixed-rate debt decays under inflation. Meanwhile, David is sitting on a completely passive asset. When a market drop hits, he doesn't have to fix a broken water heater at 2 a.m. or deal with an empty rental unit. A 20% drop in stocks is to David a bad line on a screen inside a frictionless holding. The wound is psychologically uncomfortable, but structurally clean. And now the quietest fact in this entire debate. Run Marcus's numbers forward and ask at each year a simple question. If every single hidden cost of real estate is factored in, property taxes, maintenance reserves, capital expenditures, property management fees, and vacancy rates, does real estate still beat stocks? The answer stays yes, as long as fixed mortgage rates remain lower than the combined rate of property appreciation and debt paydown. But the moment you eliminate cheap debt, the math flips completely. Unleveraged real estate loses to index funds almost every single time. The magic was never the dirt or the bricks. The magic was the mortgage. The structural advantage of real estate didn't happen because houses are intrinsically better investments than America's greatest corporations. It happened because financial institutions willingly lend ordinary people massive capital to buy homes, but will never lend that same money on those terms to buy stock index funds. So if the outcome is heavily driven by structure, a better question is how do you analyze these two assets fairly? Comparing raw returns alone can't answer that. That could be misleading. 10,000 market simulations can. Take those two asset classes across decades of economic environments. Run the same $100,000 through both systems across thousands of scenario variations. In pure buy and hold stock runs without additions, the average portfolio grows steadily, but suffers severe volatility swings that test human discipline. In leveraged real estate runs, the failure rate spikes if the asset is cash flow negative early on. If rental income fails to cover debt service during vacancy periods, the owner gets forced to subsidize the asset out of pocket. Sort those thousands of runs by one thing only: how the operational cash flow went in the first 5 years. In the real estate runs where cash flow was positive from day one, the long-term wealth creation rate is overwhelming. In the runs where cash flow was negative, investor default rates jump dramatically. The survivors in real estate weren't the ones who bought in the prettiest neighborhoods. They were the ones who prioritized initial cash flow over speculative appreciation. That's the fragile window for property. A stretch of about 5 years after acquisition, where an undercapitalized landlord can be ruined by a single roof replacement or bad tenant. Stocks don't have this operational fragile window, but they lack the explosive structural boost of low-cost leverage. And here's what that means. If you have low capital and no time, forcing yourself into real estate will expose you to operational risks that your balance sheet cannot absorb. But if you have stable income, access to fixed credit, and patience, real estate allows you to build multi-million-dollar portfolios using bank capital. The answer isn't picking one based on emotional loyalty to bricks or stock certificates. It's building around the 3 levers that dictate total return. Lever 1 is called Amplification, and it controls the total size of the compounding base. In real estate, this is safe leverage through fixed-rate loans. In stocks, this is consistent monthly dollar cost averaging to continuously artificially expand your asset base. Lever 2 controls the drag. Every asset suffers friction. Real estate loses money to property taxes, insurance, maintenance, and transaction costs when selling. Stocks lose money to capital gains taxes when rebalanced, fee ratios, and emotional panic selling. Reducing drag on stocks means holding tax-advantaged accounts like IRAs or 401ks. Reducing drag on real estate means utilizing tax depreciation and Section 1031 exchanges to defer tax indefinitely if the fact that structure beats raw speculation is the kind of insight you want to keep seeing. Clicking the like button and subscribing tells the algorithm that, and it genuinely helps shape the research that goes into these deep dives. Lever 3 is liquidity and effort efficiency. Stocks win on liquidity and zero labor. Real estate wins on control and tax benefits, but demands operational attention or management fees. Stack all 3 levers together. If you take the tax efficiency of real estate depreciation, pair it with conservative leverage on cash-flowing property, and reinvest the excess cash flow back into liquid index funds, you bypass the limitations of both asset classes entirely. The investor who relies solely on unleveraged stock picking takes decades longer to hit financial independence. The investor who overleverages into bad real estate deals gets wiped out during a vacancy. But the investor who uses real estate to harvest cheap equity and tax shelter, while using stocks for liquid diversification, turns a standard income into generational wealth. A video that stopped here without addressing current economic realities would be lying to you by omission. First, interest rates change everything. When mortgage rates sit at historic lows, real estate leverage is a super weapon. When rates double, housing prices decouple from cash flow. And stock index funds become far more attractive on a risk-adjusted basis. Second, real estate is an active business masked as a passive asset. Unless you pay a property manager 10% of gross revenue, which immediately cuts into your total math. Stocks require zero labor. Your time has a dollar value. And if you spend 10 hours a week managing tenants, that labor must be subtracted from your investment returns. Third, geographic concentration is a real risk. A stock index fund spreads your money across 500 massive global companies. A single rental property puts $500,000 of your net worth onto one physical street corner, subject to local property taxes, neighborhood decline, and natural hazards. Nothing removes structural trade-offs. Not real estate guru courses, not stock picking apps, not promises of effortless passive income. What understanding the real math changes is that it takes the decision away from hype and hands it back to clear numbers. Uneducated investors chase whatever asset made headlines last month. Informed investors choose the asset system that fits their local market conditions, tax bracket, and capacity for leverage. Here is everything you now know that most people never will. Wealth accumulation is a structural problem, not just a return percentage race. The same starting capital in real estate can dwarf stock returns purely because of asset size leverage, but only if cash flow protects you through the fragile operational window. Stocks offer frictionless, maintenance-free compounding with total liquidity, making them superior for pure passivity. Against these choices stand three levers: amplification through safe leverage or systematic additions, drag reduction through tax strategy and cost control, and operational balance between time invested and returns earned. The question most people ask is, which one makes more money, stocks or real estate? 30 years of comparative market data demonstrates that either asset can make you a multi-millionaire or leave you trailing inflation if mismanaged. The question that actually contains the answer is the one almost nobody asks. Which structural advantage fits my balance sheet, my local market, and my personal capacity to manage risk today? The math is on the table. Run yours before you deploy your next dollar.